Next topic on the show is diversifying your investment portfolio towards international market. In today's rapidly evolving market environment, investors are looking beyond the domestic market to capitalize on growth potential, diversification, hedging against local market volatility. However, the current global market situation brings both opportunities and challenges, making it crucial for investors to approach international investments with clear understanding of the global landscape. Tensions between major economies, trade disputes, and geopolitical risk have created volatility in some regions. Central banks, particularly the US and Europe, are adjusting interest rates to combat inflationary pressures. While the world economy is on a recovery path, uneven growth across regions still persists. Now, developed markets have seen steady but slow growth, while emerging markets, especially in Asia, are experiencing robust growth rates. Now, countries like India, China, Southeast Asian nations are witnessing rapid urbanization, technological innovation, and expanding middle class, providing significant investment opportunities. So let's look at the current international market scenario in terms of your investment, which economy to look at, and looking at the investment ceiling also, which has not been raised yet. Now, in Feb 2022, SEBI temporarily stopped mutual funds from investing in foreign stocks to ensure compliance with the $7 billion cap set by the Reserve Bank of India. A separate $1 billion limit per fund house has also introduced, for foreign investments, including ETFs. So what are the options available for you? So let's deep dive into this. I have with me Ashish, Shanker, MD, CEO, Motilal, Oswal Private Wealth, and I have with me Hemant, Rustagi, CEO, Wiseinvest. Hi, good evening and welcome to the show. All right, Ashish, let me first come to you because, as far as international markets are concerned, we are looking at Hang Seng Index, surged by 21% this year, reflecting robust investor enthusiasm. The CSI 300 Index, which tracks large cap stocks, on the Shanker exchanges, reached its highest level in 2025. We've seen a mixed bag of responses as far as US markets are concerned. So how are you looking at international markets right now, and specifically what region economy are we talking about?
Yeah, thanks, Kavita. It's always a pleasure to speak to you and your viewers. Like you rightly pointed out, increasingly as domestic savings pool is growing, it has become important for investors to also have regional diversification, right? What happens when Indian markets get very, very expensive? So you have the LRS route through which, per PAN, one can invest $250,000. Other than that, there is also a route through Gift City, mainly for large family offices where you can do 50% of the net worth of the holding company. But predominantly it is $250,000 because, like you pointed out, there is a limit to the Indian funds investing overseas. Now, in terms of geographies, we believe that the best diversification and correlation benefits is offered by US. So we do believe that every portfolio between, let's say, 15 and 20% of the overall equity allocation should look outwards. And within that, US should be the largest allocation because it offers correlation benefits and it's one market other than India which has compounded wealth over long periods of time. Of course, in the recent past, we had pointed out that China was cheap and it could be a tactical trade, and China is continuing to do well. We do believe it will do well. But at best, geographies like China are tactical opportunities because we've not really seen long-term wealth creation happening in these markets. As you know, there is a whole lot of government intervention in China. So US offers the best diversification and correlation benefits for investors in India who want to have international diversification.
Hemant, now, so China and US, Ashish explained. I want to understand from you the current scenario as far as Europe is concerned, and also Japan, because if someone really wants to look at stability in their portfolio, can we look at these markets also, Hemant?
Yeah, I think Kavita, look, there are developed markets, there are emerging markets. So clearly, if you are looking at geographical diversification, US has to be the mainstay of that. Then, of course, there are opportunities in Japan and Europe. But I would say that if you're looking at developed market, I think the allocation to that, major part of that has to be in US. Important thing I think I would like to say here is that, look, there is a slight change in the scenario. What we're seeing is that the dollar index is cooling off. It's come down actually. So that makes maybe the emerging market also slightly better opportunities than what it used to be. But the key factor is, how much allocation do you do to US markets and to emerging markets? Look, my belief is always that, like I said earlier, that US has to be the mainstay of your investment abroad. But now, depending on if you think that the returns from US to your portfolio have been pretty good, maybe some part of it that can be allocated to emerging markets. Or if you're looking at allocating fresh money, maybe that money can be allocated to emerging market, because I do see some opportunities there. But I think overall, the bias has to be towards the US markets.
But also within the US market, Ashish, what pockets can we look at? Are we talking about tech-specific investment strategy? See, we all can agree on the fact that an investment portfolio, if you want a diversification of an international type, you should not go beyond 5 to 10%, max 15%, depending on your risk appetite. And it's good if you align it with a goal, because the currency fluctuation is very important for you to factor all of that in. So if one has to really consider the US space now, are we looking at tech-specific theme? What do you recommend?
The moment you diversify your portfolio outside, it's important to keep it simple, because trying to understand which stocks will do well in the US itself is a very challenging task. So we believe that the first approach should be through index funds, and the two indices that have shown compounding effect over long periods of time. One is the S&P 500. There are a few local fund houses who have a feeder into the S&P 500. Motilal Oswal has one. And the other index is NASDAQ. I think these two should be the mainstay allocation of the US portfolio. Of course, for clients who can allocate larger money, they can hire advisors overseas and remit money to the advisors and take their help in allocating to individual stocks. But I can tell you that over long periods of time, it's a very tough thing to do, because you have to monitor it very closely. So the best approach, Kavita, first will be to just buy these indices, the two indices which are very diversified and which have shown long-term compounding, the S&P 500 and the NASDAQ.
Hemant, now talking about those investors who already have an international diversification and are in profits, Hemant, do you think it's time to also book in certain amount of profit and maybe reallocate? You need to really realign your portfolio, because as we all predicted, or we sort of got a sense at the beginning of this year that this year is not going to be the year where you will get returns that you got in last 2 to 3 years. So you anyways have to realign your portfolio, your exposure towards across market caps in Indian investment as far as concerned. So should we be doing the same as far as our international exposure is concerned, Hemant?
Well, absolutely, Kavita. I think there are two important things here. One is obviously the geographical diversification is important, and the second is what kind of allocation you have there. Now, obviously, some of these markets, like for example, if you see the US markets have really performed very well as compared to the Indian markets. So it's quite possible that your allocation that you made to US markets is obviously showing great returns. And if you wanted to cap it to around 10, 12, 10, 15%, maybe slightly higher. But that's fine. But because you're seeing some kind of volatility happening in the US market right now. My belief is that you need to maintain your allocation at all times. Yes, there can be some tactical allocation, like I said earlier, that if one sees that okay, maybe entire money is invested in the US market, so some part of it can be taken out and maybe invested in other markets. But otherwise, I think it's important not to try to time it, because timing, as we know, whether it's a domestic market or international markets, I think it's very, very difficult task for investors to do that. So maintain your allocation, but maybe some realignment definitely. At the moment, like I said earlier, considering the fact that the dollar index has come down, and that makes emerging markets attractive.
Sure.
Unfortunately, I think there are some funds which are still accepting money in the emerging market funds.
Right.
So I think there is an opportunity for investors to kind of realign the portfolio by allocating some money to emerging markets.
Sure. Quickly, Ashish, I'm just left with 30 seconds time for this discussion. Red flags that you might just want our viewers to understand when they diversify internationally.
Yes, I think it's important to keep it simple. A lot of people chase ideas because it's very complex. So don't do anything complex, because it's not the home market for most investors in India. I think keep it simple. That is point number one. Point number two, try not to get stuck in anything illiquid. keep things extremely liquid so that you can exit if things don't work out. And thirdly, understand the taxation because even though you take your money outside, you still have to file your taxes in India. So understand the taxation implications and then proceed accordingly.
Piece of advice. With that, thank you so much, Ashish, for being on the show always and helping our viewers, doing the hand-holding towards their investment strategies. Thank you so much. All right, Hemant, request you to stay on because we'll take a quick break and post that let's begin our live financial planning session with Hemant Rustagi.